All right, good afternoon, ladies and gentlemen. Thank you for attending this Market Insights Virtual Summit. This is the last session for the day, and we are hosting this fireside chat. All right, so before we kickstart this fireside chat, I just want to do some quick announcement, all right? So just want to thank our sponsor, Pepperstone, SG Securities, also known as SocGen, and Tokenized Exchange to make this event possible. Okay, we also want to thank our media partners and also do like our Facebook page and our Telegram channel to get the latest market updates and price mover and interesting market news. All right, it's very simple. Just search for MarketWise Asia. All right, so and if you are watching this webinar, right, for the best experience, watch it on a Chrome browser. Ensure that you have stable Wi-Fi. And if you have connection issue or streaming issue, right, please do not panic, right? Just click on the red reconnect button at the top of the screen and it should work. And the worst come to worst, it still doesn't work, right? Just exit the browser and enter by the same link again. And today, our speakers is Geoff Howie from Singapore Exchange and Goeng Yao, Straits Times Senior Correspondent. And the host for today is Dr. John Wong. He's the adjunct professor of Lee Kuan Yew School of Public Policy and the president of a medical device startup company going for IPO in Hong Kong. And today, we shall talk about the market outlook for 2021 and the opportunities and the challenges ahead. I'll hand over the stage to John.
Thank you very much, Alex. Thank you very much. Well, I think this is a great session. For the past 2 days, everybody has been so hyped up, with so much information absorbed into your brain, and the whole market, is so exciting at this point of time. Everybody is like, wondering. On one hand, is the US going to have any major actions that is causing the market to disrupt? So on the other hand, the next moment, even when there's a huge chaos, the stock market continues going up. Yeah, so it's almost like it's totally unpredictable. And today, for this fireside chat, we have with us, Mr. Geoff Howie. He's the Singapore Exchange Market Strategist, very experienced, 20 over years of experience in the financial markets and economics. He has a strong background in global macroeconomics. He has a reputation for cutting through market noise and the ability to identify the key market drivers. Okay, so today is a no hold bar thing. Okay, we're going to go straight into what works, what doesn't, what's going to move forward. In fact, we want everybody who's online to stand by your questions. Okay, today we want your answers to be addressed. We want you to have a clear direction of what is going to happen in 2021. What are the opportunities, and how can you make your money grow? So, Geoff, how are you?
I'm good. Thank you very much for having me and Yao on. Thank you.
Yeah, Yao is offline for a while, yeah. So I wanted to introduce him as well, but I seen him offline.
Good. Yeah. Yeah, no problem. So, do we cut right through then?
Yeah, let's go in first until he appears, and then we'll strategically intercept and introduce him.
Yeah, great.
Yeah.
Okay, so the state of play is, of course, the coronavirus. That's the key market driver, the key social and economic driver of everything that's happening in the world. And whether you're in Singapore, whether you're in Hong Kong, Sydney, New York, Dallas, Paris, London, we're all facing the exact same challenge. And that has basically played out with very similar playbooks across the stock markets, across all the asset markets, across the central banks, across all the governments and the fiscal stimulus, which has seen very synchronized moves across the global stock market and I guess to an extent the global asset classes. Now, the key big driver behind a lot of the buoyancy in the market has been central bank expansionary monetary policy. One thing that doesn't get so much attention from Washington these days is the fact that the US the US money supply is currently growing at an annual rate that has not been seen for more than 100 years. So there's incredible monetary expansionary policies in place, and what that does is bring down all the non-risk type of markets and pumps up the risk markets, and hopefully, more importantly, pumps up a lot of the economy, much of which is not actually listed in the stock market. So that's the prevailing big force, John, that I would say is the key overarching theme for the market coming into this year.
Yeah, marvelous. So talking about this great money supply that is being pumped into the market, we have with us Mr. Goh Eng Yao. Eng Yao is he's the guy, his name that's seen in the papers. He's a former senior financial correspondent with the Straits Times, the BT. He has helped him for a decade, the Caijing, the small change columns in the papers, and he's the author of 3 books. And I think Joff has one as well, right? Small Change.
Yeah. All three. I've got all 3.
You have all 3, yeah?
I only have one signed.
Yeah, so let me introduce the first book, Small Change, Investment Made Simple. Sequel, Small Change, Turning Cents into Dollars, and Market Smart, How to Grow Your Wealth in an Uncertain World. Ladies and gentlemen, welcome, Eng Yao. Hi. What do you think of this money thing? How does that...
You said it again, right? Growing your wealth in an uncertain world. We are in a very uncertain world. I think there's a very big disconnect between Main Street and Wall Street. Wall Street obviously thinks that the sun is bright and shining, and the market will keep on going up forever. Which is why I think if you notice, right, except for the first trading day of the year, right, every day has almost been an update on the markets in the States. And in Singapore, right, we have actually started to play catch up last week. I was quite amazed that on Friday, right, the banks, I think 2 of the banks, right, rallied more than $1 each. Something which you have not seen in a number of years. And as Jeff Howie said, I mean, the reason is because of the US Federal Reserve monetary policy, pumping $110 billion a month into the system, and then depressing all kinds of yield all over the place. I think if you have been a saver like me and you go to the bank, you'll notice that even 1 year fixed deposit, right, now only pays you 0.5% interest. So people are always looking for yield, and there's no yield to be had in putting your money into fixed deposit. There's hardly any yield if you put into bonds. So people put money into the stock market. Last year was tech. This year people think that the economy will do very well, so they have started to re-rate value stocks like the banks. Some have positioned themselves to hospitality stocks and aviation stocks, thinking that once the vaccine, right, causes its way through the population, right, we'll all be vaccinated, life will come back to normal. But I just have this doubt at the back of my mind. Investors are just making the assumption that everything will go on smoothly. But as you noticed at the start of last year, no one could have envisaged that there could be one tiny virus which can devastate the vast tracts of our economy and continues to terrify huge part of the world. I mean, Europe is in near total lockdown. I mean, in the States, right, I think if you watch CNN and CNBC or one of those US channels, right, you'll find that all the newscaster are giving you grim prognosis that the rate of infection now is actually worse than the worst days in April. So we are living in a very uncertain world. You really have to make your choices. Whether the market will continue to rally very hard this year, thanks to the Fed expansionist policy, or we have part 2 of the pandemic. So I'll hand it over to John.
Is he? Have we lost him?
John is
there
not
he is.
John is not in the room right now. I think he's some connection issue already. Yeah, but moving forward, you see, maybe I can just take over for a short while. So, as the US market is going to an all-time high, right? But for the Singapore market, it is still, at the range is between 2008, 3000 plus, 2005, 3008. So, how do you think the Singapore market will fare in this upcoming year? Because for the US market, it's really run up for all-time high. Really.
Well, if I'll go first on that. It also depends on US markets because okay, so we closed Friday at 29.90, not far off that key psychological level of 3,000. And I say it's a psychological level because sometimes when the index breaks these key levels, it can get more attention, and some people tend to get a little bit carried away sometimes, and therefore it does act as a little bit of a support or resistance or somewhat, and hence I guess what's been importantly teached over the past 2 days, sticking to your trading plan, becomes a really important part of your approach to investing again. But look, a lot does depend on the US. So the STI is 29.90. We're 10% off the January 2020 high, which was at 32.80. So if the STI rallied another 10%, we'd be back to where we were at the beginning of 2020. Now, if as Anyao pointed out, there's a lot we've got a vaccine. We've got multiple vaccines, and we've got a mutant strain, and that Moderna vaccine supposedly is effective with the mutant strain. But nonetheless, this is going to be a testing time because we saw at the end of June 10 million cases of COVID-19 grow to 80 million cases at the end of 2020. The good news is, I guess, the mortality rate has declined from 4.9 to 2.4%. But the thing is, it's going to take a long time to get people vaccinated. In Singapore, we could do it relatively quickly, but you think of the logistics of getting everyone vaccinated in the US, the Philippines, Indonesia, China, India, and so forth. There's going to be a challenging time. So hence that second line of defense is going to be really important as well. That is the mask wearing, the social distancing, the tracing and the tracking, and of course safe work practices. All right. But as I said, it really depends on the vaccine. And look, everything's having a little bit of a measured move. Our banks are the key drivers of the STI. The 3 banks make up 40% of the STI, and they're pretty much for all of 2020, they were stuck in a very sector-driven trend. That is, US banks were off 20% for most of the year. Our banks were off 20%. But in November, when the vaccine news came in on the optimistic end of the estimations or the schedule, they rallied, and they all rallied in line like the US banks. So our trio of banks, they went from a price to book ratio, I guess trading at a 15% discount to their book value, and they're now trading. 2 of them are trading at book value. That's UOB and OCBC, while DBS is trading at 1.3 times its book value. Now, overall, that's an average of 1.06, and it's very much in line with what we saw in the banks in the US. The banks also moved from a median, the top quartile banks across the world, I'll say, they moved from a median PB of 80.85, 15% discount, up to their book value at the end of the year and a little bit above the book value this year. So STI, of course, takes its cues from the big sector forces in the world. And of course, the ASEAN region, we are very much beholden to. Our STI is, our Singapore companies, they make up less than a quarter of the FTSE ASEAN All Share Index, but the moves of the STI and the FTSE ASEAN All Share Index are something like 95% correlated. So, as we said, monetary policy matters, but also the big sector drivers will matter as well, and the way that the investors and the actual corporations adjust and navigate the next few months matters. So what I'm trying to say
talk about this.
I'm just trying to say we're not going to go up to 36.40 that 1st of May, that May 2018 high, unless the rest of the world is moving in that way as well. We're not going to go back down to 22.10, which is where we were in March 2020, unless the rest of the world comes off as well, such as, the vaccine's not working and so forth. So risks are there. But the other risk as well that, I would like to address during the panel, because Angyao knows a lot about this as well, is inflation, and that the consequences of all this monetary policy pumping, and how that will help the central bank with this monetary policy pumping, reducing their debt, but what to look out for in the markets as well.
You see, the thing is that I think Alex is right. There's a psychological resistance at the 3,000 level for the STI. So if the STI manages to stay above 3,000, which it can if the banks continues to rally, then of course people, I mean, you must bear in mind that last year there was a new phenomenon. Retail investors started coming back into the market again.
Yeah.
Not just in the US, in Europe, as well as in Singapore. Very surprisingly. So there's this new phenomenon, and this phenomenon is actually initiated by interest rates coming down to record low. It's if you look at bank interest rates, right, they are even lower than during the aftermath of the global financial crisis in 2008. As I mentioned just now, your fixed D 1 year rate for some banks is only 0.3 to 0.5%. So a lot of people have been sitting on cash on the sideline, and they are waiting to go into the market. So that will actually provide some kind of cushion for market indexes, and it also provide a cushion for share prices. So I agree with Jeff that I don't think STI will go back to the 2,200 level. Even if, let's say, for some unknown reason, right, the vaccine does not work the way it was supposed, the way it's supposed to be. But I also agree with him that I don't think we'll go and see that 3,600 level anytime soon. There's one other point which I want to make, and that is you must bear in mind that within the next 2 weeks, we are going to have a change in US administration from Donald Trump to Joe Biden. And the Democrat in the US now controls both the Senate, the House of Representatives, as well as the presidency. And Democrats are known to be big spenders. So you can expect quite a big fiscal stimulus. And that could be inflationary. We are
Totally.
pumping in $110 billion every month. You have the new incoming US president signing checks to US people. And where's the money going to come from? My fear is that it will come from the rest of us in the form of negative interest rates. Because if the US stimulus takes off, you expect inflation to go up. But the US Fed has already said that they are going to set this extremely low interest rates, right, 0.1, 0.2% until 2023, which means that your money, right, if you keep in the bank, right, will not keep up with inflation. You really have to look for alternative. The alternative could be in the stock market, it could be in gold. Some people, I read somewhere last week that there's one hedge fund which actually put $1 billion into Bitcoin. So investors, right, if you do have some cash, right, you really have some tough choices to make this year. So I'll just pass back to John.
Yeah, I think it's really interesting. You brought out, Ingyo brought out a couple of good points. I was cut off for a short while in this one, but I heard these very important points by Job and Ingyo, and I think that Bitcoin has broken brand new records, and a lot of the money, based on the stimulus, based on the free money readily into the market. Last year, during the March, just now you guys mentioned about how the market downturned, and then it is the retailers that went in to buy the stocks. There was a Bloomberg article that said that the foolish money leading the smart money, and the smart money refers to people like you, like institutions. So what is this year going to be? 2021, people have been beaten last year. Those who missed the chance, they refuse to miss it again. They might be eager to get on board. Is there going to be such big turbulence that they're going to miss the timing or somehow dance in the wrong tempo? How does it work?
Well,
I think there's a John Templeton that says that the bull will actually die on optimism, right? I'm a very, very cynical person.
I'm
but the trouble is keeping cash is not an option.
So Ingyo says keeping cash is not an option, but the bull will die of optimism. Geoff, what do you say?
Well, I mean, we've got, there's a lot in our market that we can kind of use as indicators of that. I think one key one was, you know, we've got all these ETFs. We've had about 30 traded ETFs on SGX, and going into 2020, most of the assets under management was in the Safe Haven Gold ETF. Now that came off considerably. I think it came off something like gold making up 27% of all the combined AUM of ETFs on SGX, falling down to something like 18%, and therefore showing investors were risk on. But the Bloomberg article, I think, it had that headline, but in the detail, it was more about buying low and selling high. You know, retail in our market tend to be, that they were net sellers of the banks last year, and they were net buyers of the banks this year. And it really depends on the market itself. If the market, if we continue to see these gains, you would expect probably retail would be net sellers, and then when the banks come off a bit, that's when the net buying comes in. So it can change on a day-to-day basis as you have gaining and markets kind of rising and declining and so forth. But the key thing we noticed too is that the counters that were actively traded by the retail investors, there was quite a lot of breadth there. The understanding of the markets, the understanding of some of these niche businesses, particularly like the new businesses like nanofilm technologies, retail do have a handle on them, and they understand. And I know Enyal's, from me reading what he's written in recent years, it's really important to understand your market. Don't just know it; you've got to understand it. And I think
you have to understand what you're buying into.
Yeah. So I think they understand that those shares, the DBS business, when it's trading at $17, it's very different to understanding buying DBS when it's trading kind of now at $27 and so forth. So
no.
Yep.
You see, the thing is that there's one reason why the bank stocks are rallying all over the world. You see, the thing is that if you look at the US 10-year yield, right, it's breached 1%.
Yeah.
So people are expecting interest rates to actually go up, and it's actually good for the bank. Their net margin may actually go up, so earnings may go up. And of course, in March, right, at the darkest moment of the pandemic, right, a lot of people were expecting the banks to lose a lot of money as business failed.
Yeah.
That didn't happen. So this year, right, they expect the central banks to relax their grip on the banks, that they will be able to start paying dividend again, they will be able to start doing share buyback. And that's positive for the banks, which is why the banks are doing catch up, not just in Singapore, but all over the world. I mean, if you look at Hong Kong, HSBC has quite a nice run. In fact, the only banks which don't seem to be doing well at the moment are the Chinese banks. I don't know why. I have not actually examined in details. But if you look at the US banks, the Singapore banks, the Hong Kong banks, right, they've actually rallied quite a bit the last month or so.
Yeah. So with this movement in the bank prices for these various markets, especially I think DBS the past few days has been doing pretty okay. Is the market, especially US market? I have questions from the chat box, and in fact one of the questions that is that they're very concerned about is the US market overpriced. I think many people who invest, they are looking very closely at the US market. So do you guys think it's really overpriced now, or is it still the start?
Well, okay, what's been driving much of the gains is, of course, the technology sector, which overall, the technology sector is now bigger globally than the financial sector, which is a little bit of a concern because so much of these technology business are consumer orientated or consumer facing. And we do know, for instance, that tech reg across the world, or tech regulation, is pretty much dwarfed by financial and banking regulation. So we're seeing these winds of change in at the moment, and increased focus on tech reg. And tech, as we said, tech has expanded significantly over the past 10 years. It's grown so that it has a bigger market presence than financials itself. Now those companies generally are trading at around a 40 times PE multiple. The big technology companies in the US and so forth. And then the financials themselves, I guess the companies that are more like the banks, more broadly economically aligned, aren't trading near their premium highs. Globally, and in Singapore, I think the high of our price to book ratio was around 1.3, 1.4 times. Now, at the moment, as we said, the big banks across the world are trading less than 1.1, as two of our three banks are, with the exception of DBS at 1.3. So not all the US is priced expensively, but nonetheless, this is where you've got to kind of understand that healthcare stocks that are producing medical supplies or biotech equipment, digital orientated tech stocks and so forth have moved very differently to those sectors that are more broadly economically aligned or so-called cyclical and so-called value sectors going into this. So part of the rotation from momentum to value has, of course, seen these value stocks catch up, as we've been saying, since November, for the past 10 weeks or so.
Yeah.
The other observation I want to make is that you see Singapore investors, right? A lot of them are into REITs.
Yeah.
So I suppose one question is, how will the REITs do this year? I mean, if interest rate continues to stay low and inflation takes off.
Yeah, exactly.
If on any average trading day, right? I think except apart from the banks, right? I think a lot of investors would actually be looking very closely into REITs because a lot of them are actually they actually buy REITs for the dividend payout.
So what do you think then?
Last year the dividend payout for the REITs aren't that bad.
Yeah. But what about this year? Because if they continue to stay work from home.
No doubt there was a circuit breaker. I mean, a lot of retail malls were shut and all that. But I think the payout for the REITs wasn't that bad. So that is one sector which I think investors should also be looking closely into this year.
I have
Not
a
just
question.
in Singapore, but elsewhere as well.
Yeah, I have a question to follow up to this REIT question, especially the payout. Because last year the government was giving a lot of support for the various businesses to stay to continue paying off some of the rents. But apparently some of these grants have already ceased towards the end of last year. So this year there might not be that much support, and with all these wave 2, wave 3 going on, actually what should be a practical expectation of our investors with regards to REITs for 2021?
Maybe Jeff would like to go first.
Yeah, sure. Look, I'll pick up straight away what Enyao was saying. You've got inflation risk, and REITs in the US are known as a little bit of an inflation hedge investment as well. So, and as we said, there's inflation forces building up, not just the monetary policy, but you've also got commodity prices rallying very high. Bulk commodities up 50%, crude up 30%, softs like sugar and crude palm oil are also up around 30%. You've got this is since mid last year. You've got also this potential for pent up demand should we get to overcome some of the worst problems we've been seeing with the COVID-19 recently. So that can serve as an inflation hedge, but also with the low interest rates, as Enyao was saying, US 10-year yields at 1% means that if the yields on the indexes for the REITs that we have here is at 5%, you've got a 400 basis point premium to the risk-free rate, essentially, at least. So that's another consideration. And then I guess investors also look to what's really becoming quite a bit of a sub-theme for the REIT market, the acquisitions that they're making. A lot of REITs are making acquisitions into buying new buildings, renovating, revitalising buildings. Some are even diversifying across property types, such as China Retail, Capital Land Retail China Trust, buying some buildings attached with retail malls that are office related, and then of course like Mapletree Industrial Trust acquiring data centers as well as renovating some of its industrial properties into into a high tech cluster and so forth. So that revitalization and growth of the REIT portfolios, I think, is one that definitely gets attention on the investor radars this year.
Yao?
Now, I just have a few observations on REITs. 2 years ago, right, when I was I do a bit of training every now and then. So I gave a talk on REITs, and then at a point in time, right, one observation which I made is that the price to book for REITs, right, at that point in time, right, most REITs were trading at over 1 time book value. Wow. And I said that this just isn't right, because if the REITs is, I mean, if your REITs is selling at over 1 time book value, right, you might sell all the buildings, and you actually get a better return. No, sorry. What I mean is that usually REIT should by right be trading at or about book value. They should not be trading way above book value, and that was what happened 2 years ago. Then last year, because of the pandemic, most of them sank below book value. And I think one of the reasons why some of the REITs sank below book value is because REITs are highly geared instruments. They actually borrow a lot of money to finance the building which they buy in order to give you, the investor, the rental yield. It's what we call a leverage play. And then when times goes bad, leverage plays also have their problems. The banks may refuse to refinance the loan that they give the REITs to buy the buildings. And then if you can't get the banks to refinance your loans, you have to turn to your REIT holders for the money to pay off the banks, which is what happened to a few REITs recently, if you notice. So my advice to investors, right, if they are actually looking for REITs, right, this year, is, apart from looking for the yield, right, you also should be looking at the tenure of the loans taken by the REITs to buy the buildings, as well as the sponsor, whether they have the means to, let's say, do any rights issue. If, let's say, the banks for some no reason, right, get COVID and refuse to refinance, and they cannot get any form of alternative funds.
Oh dear.
I mean, the thing is that when times are good, you always also have to look at the downside.
Yeah.
Yeah.
You know, guys, talking about good times, bad times. But right now we know that you know, in China, the latest the richest man in China is no longer Jack Ma. He's known as Zhong Shanshan. And this guy is the owner of Nongfu Shanquan, the mineral water, and he's now the richest man in China. Okay, so we have questions from our participants. They're asking that, you know, with this China-US tension, this trade war, even with Biden, is going to be a continued conflict. How will this affect China's stocks? Will Zhong Shanshan continue to be the richest man in China, and how will this be? You know, how, will this affect investors in terms of making investments into China stocks?
Yeah, the big growth driver for China recently, it hasn't been the US. It's been its rising middle class. It's basically been growing within organically, which is conducive to these type of businesses, Jack Ma's businesses, as well as the water business. And look, its prospects are good for this year. Going into this year, I think, you know, all the, you know, OECD, World Bank, IMF have China looking at achieving 8% GDP growth this year, and at the same time continuing to rebalance into this consumer-driven, more services-orientated economy. And it's made a lot of inroads over the past 10 years with this. Now, whether that survives, I think the more important thing for China is its housing market. Its stability of its housing market's a really important driver because it has such a high saving rates that the housing market stability can become somewhat of an enabler, if you will, for the policies to drive this more consumer-driven economy. Okay, so housing prices, even the data coming in at the end of last year was showing there was a lot of stability, but and there's regulations coming in to basically make sure the banking activity is less related to, or lesser related to, housing activity and more related to growing important productive segments of the economy, such as SMEs. And I say it's productive because SMEs and provide employment and output and so forth, and it becomes a really important means for this reorientation. So we are, looking at the prospect for China to grow within. SME growth is expected to play a key role with that, with all this really high, most household savings in China are in the form of home ownership. So seeing, I guess, that saving rates come down a little bit and getting to work a little bit more in the SME and the not just SME but micro-sized businesses would be, the key thing to look for in China growth, more so than what we've seen with the recent US-China trade war. The good thing is that you look at Biden's incoming cabinet, your Secretary of State, your National Security Advisor, Anthony Blinken, Jake Sullivan. Those guys, they're all about multilateralism. They were big critics of the unilateral approach that the previous administration was taking with China, this stability it was causing throughout the region. They're big about setting the rules with the likes of the World Trade Organization and sticking with the rules. And that's good for a lot of these businesses within the region that do rely on this more integrated and bigger, wider supply chain that China is, I guess, part of because in their recent restructuring, all the e-commerce and so forth initiatives, we've seen the web of trade increase dramatically as well over the last 5 or 6 years. Interregional trade of China and all its developing Asian neighbours has well offset declines of trade with the US. So overall, there's a lot of, I guess, great economic rebalancing that we're seeing that doesn't necessarily get the headlines, with the Twitter account obviously getting all the headlines when it comes to China. But can I just also add? Yeah, sorry. Go then. Yeah, sorry.
No, it's fine. You see, the thing is that with China stocks, right? I think you must bear in mind that the biggest driver in the market is the Chinese government. The Chinese government and the policies which it implements or plans to implement. I think one of the biggest example, right, is the pull out of ANT IPO in November.
Jack.
Last minute pull out. Yeah. So and then the subsequent problems experienced by Alibaba. Yeah. So and then this is not the first time. In 2018, right, the Chinese government just decided that school children are spending too much time on their computer console playing games, and they decided to restrict Tencent. Tencent fell 30% in share price. So I think where China stocks are concerned, right, it's not this trade war between China and US or whatever it is. It's the Chinese government policy which should be the primary driver. And I don't blame the Chinese government because you see the thing is that, for instance, Ant, right, it behaves like a bank, but it was regulated by a tech. And belatedly, they realized that because it's behaving like a financial institution, it has to be regulated like a financial institution. It should not be allowed to list. And then subsequently, if there are problems, right, your problems can really destabilize not just the Chinese financial system, but the entire global financial system. Yeah. If something goes wrong. So I actually don't blame the Chinese government for doing what they did to Ant, but you must bear in mind that where Chinese stocks are concerned, right, policies will continue to be the primary driver.
That pretty much sums up why today ST wrote about how Jack Ma has disappeared from the face of the
Since
public
October.
after making all the comments.
Yeah.
But very interestingly, for the past 10 years in the Chinese stock market, since we are still at the Chinese stock market, there is this big acronym. Like the US market, we have the FANG, the FANG stocks. In the Chinese market, it was always the BAT, the Baidu, Ali, and Tencent. Okay, these are the three, Tencent. These are the three very famous stocks. But there's a big saying right now that if we are still stuck at the BAT, there's going to be a big problem because currently they believe that the next 10 years will be the TMD. T is Toutiao, which is all the top news of China. M is Meituan, it's like our Grab delivery. And D is Didi, it's like our Grab food, And TMD, when I first heard it, my first reaction was like you. I thought, are they scolding something? No, actually it refers to Toutiao, Meituan, and Didi. So these three are still tech, but pretty much more related to big data because they are talking about consumer behavior and then managing that. What do you guys think? What do you think will be the sectors that will drive China market and also Asia market for 2021?
Look, manufacturing is still super important. 2/3 of all the industrial robots across the world are in Asia. China's a big part of that. China growth of the internet is massive. I still think manufacturing sector has its challenges ahead and is also I guess getting more and more attention on the radars. The companies that are servicing the adjacent stocks to those ones that you just mentioned that are a big part of their rollout. And that data centers, for instance, was the big one last year. That the stocks and sectors that are adjacent to it, and then for investors as well, valuations are super important as well. Understanding the valuations of the segments and the sectors and the business, and having some way to best understand the industries that they operate in.
You see, the thing is that any stock market will be driven by consumer behavior. And the pandemic has just hastened changes in consumer behavior.
Yeah.
So you notice, right, if you just go to the retail mall now, you have a lot of window shoppers.
Yeah.
People will actually go and shop and look at the prices, and then they go online and buy the stuff.
Gosh, were you monitoring me or something?
Oh, no.
So you expect your Pinduoduo, your Alibaba and all that to continue to do well. And if you notice, right, the MAS, right, they've given up some online banking license. And the thing is that people are expecting great things from all these online banks. So, and then we also see that the younger generations are moving online. And I think one of the banks, right, I think is it PBS, right, they say they'll close down as much as 1/3 of their branches. Wow. Yeah, I think I read somewhere they are closing down as much as 1/3 of their branches because they envisage people moving online. So you can see these changes in consumer behavior. So if you want to buy shares, right, you also have to anticipate these changes and move accordingly. Which is why I said earlier on, right, those people with cash, right, they have some hard choices to do. You can stick with the old economy stocks, and the thing is that I had quite a number of old economy stocks last year, and it was quite painful to get rid of them, but I did. So now I'm looking at the new economy stocks and what to put into them. So there's one parallel in history. This period is quite similar to the end of the 19th century. It was also a period of tremendous changes. I mean, that time, right, the world was getting electrified, and then you have your steamship coming on and all those sort of things. It's about the same. And then the thing is that as people, and then you have banks being formed. Now the thing is that your traditional banks, right, we have to evolve into online banking. So it's exactly, I mean, it's a period where great fortune can be made, great fortune can be lost.
Yeah.
And there's one other observation which I want to make, and that will be on the oil industry. If you noticed last year, ExxonMobil was kicked out of the Dow 30 stocks, the Dow Jones Industrial Average. I think it's the last original stock on the Dow Jones Industrial Average, and then it was kicked out. And then if you look, now people are also looking at alternative energy sources. It's no longer about big oil, no longer about all this fossil fuel. So I think we are into a period of very big changes. And I suppose
Wow.
as an investor, you have to take note of all these changes.
Wow. Yeah, talking about this alternative for these, the oil, the energy, I recalled recently hearing an opinion by Eric Sprott. This guy, Eric Sprott is known in the precious metal sector as like the Warren Buffett of precious metal, and he specializes in gold and silver, especially silver. So talking about this alternative, and with the Biden coming into place, and Biden is known to be very green, very environmentally friendly, and and which will result
Most
in the building
Democrats
of a lot of appliances or gadgets to support that. And apparently that will support the precious metal like gold and silver, especially silver. What do you guys think of precious metal going forward and opportunities?
Well,
I think gold will continue to do very well because it's an inflation hedge.
that's
You're saying gold, right?
Hello? Yeah.
yeah,
Yeah.
and
I mentioned earlier, right? Your Biden is going to sign a lot of checks to a lot of companies, a lot of people. There will be a big fiscal stimulus budget, right? And the Fed is going to be very helpful to keep interest rate extremely low. So your value of money will be eroded one way or another.
Yeah.
And as an inflation hedge, right, I think a lot of people will be hiding in gold.
and that's exactly why central banks hold gold. They hold gold as an inflation hedge. So most of us look at it because it's a can look at it because it's a safe haven. Lowly correlated to equities and so forth. But yeah, that's exactly why Fed, the guys that are issuing the debt and creating the money supply growth, that's exactly why they hold it. And with I guess moving into the industrial metals from the precious metals. Yeah, you would. There's a lot on the agenda for the incoming administration. It's expected that President-elect Joe Biden will go hard. He will go fast. He won't just roll out these initiatives that have climate change wrapped around the infrastructure and manufacturing initiatives that he has. He won't just roll it out slowly over the typical 3-year process. He will go hard and fast and attempt to push it all through this year. So that's creating, as we say, quite a lot of price pressures in the market. As we said, iron ore's up 70%, since the end of last year. Since mid last year. We've had incredible moves. High grade copper is up more than 30%.
Yes. So you see, the interesting thing is here, okay, with this, with the inflation, with the money getting smaller, and people supposedly should be moving into safe haven because money is just getting smaller, and they need something that's less speculative. But gold prices has not really been performing.
Where can you find safe haven?
Yeah.
Okay, there's no safe haven.
I think that's the question you ask. You have to ask, where can you find safe haven?
Exactly. And now I have a question that comes in.
Yeah.
Sorry, Inga, you were saying?
No, the problem is that if you want something safe, right, you don't want to take risk with it on it. But the US Federal Reserve doesn't make it possible because interest rate is now extremely low. You can't keep it in cash. You can't keep it in bond.
Yeah.
So you have to go into something riskier like the stock market or into Bitcoin. And even gold is not safe because gold has actually gone up. I think it's up about 30% last year.
It's now 1,850, 1850 now. Yeah.
So I mean, it started from 1,300. It's gone to 1,850.
It went to 2,000 plus.
Of 9 months. So nothing is safe at the moment. That's why I say people with cash have some very tough choices to make.
That's the problem. You see, and then there are people, now we have a question. There are people actually moving out of gold to invest in Bitcoin, which has gone to 40
I
over
mentioned
1,000.
one hedge fund put in $1 billion into Bitcoin.
Yes. What is your view? I mean, if you talk about gold as not being that stable as compared to USD, I mean, as compared to other assets, but what about Bitcoin? Where's the basis? Where's the fundamentals behind it supporting the growth?
Or I mean, there's even I think Piyush Gupta said that they're looking to explore real time money transfers overseas and so forth, which this kind of blockchain technology would play an important role in, and that obviously would really increase the efficiency of financial services. So I guess there's fundamental elements like that, but I can't answer the question because I don't understand it enough. I'm more focused. I don't, and I would dare not, attempt to try and understand it. But the tech thing's real. In that all across the world, global tech stocks were re-rated at the beginning of 2016. But we've got companies here in Singapore that are listed that have performed in line with that. I think if you look at across all the tech stocks with a market cap of at least 500 million US dollars, we've got the best performer here in Singapore, listed in Singapore, since tech stocks were re-rated in 2016. That was AEM Holdings, and that's Hive Blockchain was the second best performer, Shopify the third best performer. And AEM Holdings, there's a lot of information on that investors can use. They their revenue guidance, I think, is between $500 and $520 million this year, after $323 million record last year. There's a number of that. So they publish. So what I'm saying is they publish their sales order visibility. There's a lot of information in this business that investors are able to use and look at. So I'm not sure. I'm just saying if you want to understand something or really want to have a lot of more information, there's also stocks here that have performed pretty well as well, in line with all that interest in the tech stocks.
The only thing I know about Bitcoin is the scarcity value.
Yeah.
Unlike gold, right? I mean, gold, there's always an increase in supply every year. I mean, gold is still getting dug out from the ground. I think Bitcoin, there's actually a finite supply. You can't increase the supply, which is why the value keeps going up whenever there's a fear of inflation. But apart from that, it's hard to say whether cryptocurrency makes a better investment than all this traditional inflation hedge like gold or even silver. I suppose it's an investor personal preference. I won't invest in Bitcoin because I'm not tech savvy. I'll be quite worried that someone will actually be able to steal all the Bitcoin from my wallet.
That's really interesting thought. I just also want to add on a little bit to that, what Ingyao you said about how the scarcity and the abundant supply. Actually, in terms of the precious metal, whether it's gold or silver, especially silver, they do take a long time to open, to explore, to mine, and eventually to produce the quantity. And as a result of this, I don't know what's your view like, but as a result of this, the miners who are producing this precious metal, they're actually very much protected, because they mine, they have a fixed cost of operation, but when they sell, they're subjected to the market forces. When silver went up to $27 plus, most of the minor stocks rose and really went very fast. And in fact, the past few days, last week was a great week for silver, $27 over, and then suddenly, because of the gold of USD gold increasing to 90, because of what Inga said about the U increasing to 1%, and then USDI went back to $90 plus, and then that dropped a little bit. But somehow, what do you think of opportunities? People are asking for opportunities. What do you think of like mining stocks, precious metal mining stocks? Would that be something that people could potentially seriously look at? Because if price increased a bit, that value increased by a huge bit because of the fixed cost. but huge upside. What do you guys think?
They've been quite volatile. That's the thing. The especially silver, as you said, it got up towards $30, and those trading ranges are very high. So, the immediate for silver, that is. So the caveat for silver is, it's been very volatile. It's kind of, you see it like a little move in their inverse markets, in the bond markets, in the currency markets, and because of the monetary expansion, and you see that those flows into those commodity markets. Well, silver has been really volatile. Let me just give me 1 second. I'm going to pull up and tell you what the annualized volatility of the silver market has been. It's currently 44%. That's for silver. That's the current 1 year annualized volatility rate. It's gone from 15% in mid 2019, grown threefold to 45%. So and this is also relays the importance for a lot of miners and producers of the importance of hedging. Hedging your production or hedging what you intend to consume with the underlying futures markets.
I don't think it's just silver which has done very well, right? Last
Iron
year.
ore.
I think some base metals like copper have done very well as well.
Copper is great.
So you see, the thing is that the reason why all these commodities are doing very well is down to one very simple reason. People with spare cash, right, don't know where to put the money into. The tax have run up very sharply. So they look for laggards. And some of the laggards they found out with base metals like copper, semi-precious metals like silver. And it's all because of, I always say, it's all due to the Federal Reserve keeping interest rate at extraordinarily low rates. All you have to do is interest rate goes up, all your base metal prices will start coming down.
Yep, that's the relationship.
Yeah, because it costs more. It costs less to buy these things, assuming that the value doesn't really change.
Yeah, that's right.
Great. Well, we have people asking that we should get the C Limited to do a secondary listing here. That would be STI. Very, very, very good movement stock, obviously, that does all the games and stuff. Yeah.
That would be wonderful. Yeah. It's a wonderful platform, isn't it, Shopee? It's fantastic.
That's right. It's Shopee.
It's fantastic.
Yeah. So let me ask the two of you, okay? On your own, for the next 3 months, do you think the market will undergo any major correction again, whether it is due to vaccine not successful, whether due to a second wave? Would there be something that is going to be like last March that people have to be aware of? What do you think?
It could. There is the thing is, we're not out. Since we're talking commodity markets, let's talk about gold and crude oil. So gold was priced at 24 times the price of crude oil, the price ratio going into 2020. In the heat of March and April, that price ratio got to gold trading at 87 times the price of crude. It fell to around 37 times at the end of last year, and it's continued to fall somewhat, coming into that normalized long-term price ratio spread of the gold trading at 33 times now to the price of Brent crude oil. So it's come off a bit, but the risk is still there. It's still at a higher than elevated level than where it has been in the past. So obviously risk is still there. We're by no means out of the woods yet. Everything really depends on reaching that new norm faster than we hope. That's where most of the optimism is. Most of the turnaround growth, the fact that global growth is expected to turn around from down 4% last year to up 5% this year. That's all built into prices. We're expecting vaccine to work. We're expecting to get out of this. So that is still the key driver, the overarching risk. So you've really got to watch closely to see how vaccine deployment works. We have to obviously follow the sequential economic recovery that we're seeing. It's been a K-shaped recovery, particularly here in Singapore. You look at our manufacturing growth last year, it was up 7%, but that's biomedical and precision engineering and semiconductors. It's not transport engineering or general manufacturing. So we need to see less of the K-shaped, more of the sequential growth recovery. And, you know, there's a number of things to look at that will help us to determine, you know, if the market prices are warranted where they are.
I'll just quote one former U.S. Defense Secretary. What he said when we are confronted with a situation. So last year when we had this pandemic, right, we were confronted with what we know, unknown. The virus was an unknown factor. We do not know what are the consequences. So it was an unknown. So the market fell very sharply. This year, we are confronted with a known unknown. We know what the virus is up to. It's still unknown, but it's a known unknown. So because it's a known unknown, we have already priced in the problem. So if we are talking about a major price correction due to this coronavirus, it's not possible. Whether the vaccine works or not, I think people have actually priced it, taken it into their stride. By now, right? I mean, when the virus first hit China, right, the television images were so scary. I think all of us were actually quite frightened. By now, I think we are actually quite used to it. So I don't think the market will react the way it did last year.
Okay.
It will take something which is a lot more serious for the market to react the way it did in March last year.
Yeah.
What is a lot
So
more serious?
I don't think, barring any major foreseen circumstances like a new unknown coming up, I think we can get on with our life.
Okay, so at least that brings us some form of comfort.
Yeah.
For the people who wants to really enter into the market for 2021, it seems that unless something really unknown, I really don't know. Maybe you know,
Unknown.
the
Yes.
unknown unknowns, yeah, and then that could
Something
be
which
something.
we cannot grapple with the consequences.
Yeah, that's right. Well, that's a very good discussion today. In fact, most of the questions that our participants raised, we have addressed them, and I think you know, would you guys have any more last words of wisdom and advice, especially for the near term? I think we have both investors and traders in the chat group. Okay, so the traders want it fast. Okay, they want it like tomorrow. Okay, give them some great profit, or at least in the next week. Some advice for them, and then we'll invite Alex back.
Yeah, I publish stories, reports, whatever, almost 3-4 times a week, and they're all on the Telegram channel. So we're at the moment we're pushing most of that content through Telegram, which is through the you can find us on SGX Invest. Okay. And that's what I can help with in terms of for materials or so that we can delve a little bit more into the various stocks. We've got so many different stocks in the market we could have talked about. From the Top Club, the Riverstone, the UG Healthcare, the Keppel DC REITs, the ISDNs, the AEMs, the UMSs. A lot of happening in the mid cap and to the small cap range, particularly in the manufacturing. That if we had the whole day to talk, we would be able to get through it, but we can't. But but the rest of it short, if you'd like to follow how we and what I do at SGX, it's very different, I guess, to what some of the other speakers would have been doing over the weekend. For me, it's more all I want to do is just show you what's moving and explain why it's moving. I.e., it's for me, it's more about this stock has moved from A to B because of this. It's not so much talking about whether it's going to C or D. So I can help that I guess in an educational way. So I just wanted to mention that. Thank you.
No, I find the SGX data on fund flow very useful. Who is buying what every week? The top 10 stocks, retail and institution. I do try and look at it every Monday.
Awesome.
If I remember. It gives me a handle as to what the people are doing on the Singapore market. And having said that, I must one advice to investors is what to quote the great investor Warren Buffett: never lose money. Rule number one: never lose money. Rule number two: don't forget rule number one. So you must trade carefully in this market. Especially like the US market, right? Everyone knows it's elevated, it's at record high levels.
Yeah.
I think there's inflation coming back. So there are a lot of uncertainties in the market. You just have to trade carefully.
Yeah. That's great, man. I mean, it might sound fundamental, but fundamental works. And I think fundamental is what people have to fall back to. And do grab hold of Eng Yao's books. It's really very useful. They hold a lot of wisdom for you to know how to respond and react in these different and difficult times or turbulent times, right? Thank you so much, Geoff and Eng Yao, for your
Thank
time.
you.
And we'd like to invite Alex back online.
Okay.
All right, so thank you,
Yeah.
John, thank you, Eng Yao, and thank you, John, for your wonderful sharing. And this marks the end of this Market Insights Virtual Summit for the past 2 days. And I thank you guys for joining us and for all the talks. And there will be replay for all the talks, right? Just give me some time to upload all the videos because all the video size are very big, all right, very large files. So give me some time, I'll upload them and you should receive an email from us by tomorrow morning. I promise you, by tomorrow morning, you should receive all the replays. And do join us in the next Market Insights Virtual Summit that's going to be held in March, on March 27 and 28. We invite Rainer Teo, the #1 most followed traders in Singapore. And you should see the link on the chat box. All right. So yeah, I posted the link on the chat box. And yeah, so once again, thank you, Joe, thank you, Eng Yao, and thank you, John. I shall just end the session already. See you guys and have
Thank
a
you.
good year ahead. Thank you. See
Okay,
you guys.
thank you. Thank you.
Thank
very
you.
much. Okay, bye-bye.